So I've done my best to sort of set the stage through the lens of the data, and now we'll speak to each of you who are much more immersed in deal flow and can hopefully provide a bit more color on the state of European venture right now. But maybe we'll start with some introductions. Could each of you introduce who you are? Francois, maybe we'll start with you.
Yes, so good morning, everyone. I'm François Robinet, I'm the managing partner of AVP. So AVP is a kind of a newcomer in the venture and growth stage. We manage 1.3 billion in venture, growth and fund of fund. We were originally backed by AXA, the insurance group, and we manage 50% of our assets for AXA, 50% for other investors around the world. We do that in the US, 50% of what we do, 50% of the team, and the rest in Europe and Israel. That's us.
Good morning, Guillaume Wittrich. So I'm a partner at White & Case, a lawyer. I'm leading the tech practice out of Paris. We have a pan-European tech practice. You saw Amy Jones on stage earlier this morning, was based in London. And we advise either VCs or growth equity funds and companies from their Series A, let's say, to their exit and IPO. And we work on many of the deals that you have seen, be it Back Market, be it Content Square, and all of those large rounds.
Hi, I'm Sean Evans. I'm a senior investment manager at Vencap. We're a fund of funds that focus exclusively on venture based out of Oxford. We've been doing it for 35 years, for a reasonably long time. We invest globally, and we've been very heavily involved in the venture growth space for the last 15 years. It's probably around 50% of what we do in our portfolio. So happy to offer an LP's insight into what's going on.
And hello, I'm Jean Boursereau. I'm the management partner of Ventec. We're an early stage, only tech investor. We raised something around €1 billion over the past 20 years with two families of funds, one investing in Europe from Paris, Munich, Berlin, and Helsinki, and another one investing in China and Asia from Shanghai and Hong Kong.
Wonderful. Thanks again, everyone, for being here. I want to start by taking a look at current portfolio companies. It's easy to talk about valuations of new deals and how deal making has slowed, but I want to know sort of what you all are doing to help your current portfolio companies weather the storm, to extend runways, to make sure that there's a viable future. Francois, maybe we'll start with you.
Well, yes, I would say the problem is not now. The problem was 1 year ago, right? I think there is a kind of a collective responsibility for what happened 1 year ago. It was clearly what we can call now a bubble. I think the best comparison, you mentioned the global financial crisis. I think the even better comparison is probably the dot-com bubble. So it takes one generation to have another phenomenon. People forget, and then it happens again. But I would say when you see valuation at 160 times on an aggregate basis, right? There's something wrong. There's clearly something wrong. I mean, it may be the case that one company will be the future of Facebook, yes, but on the market level, there's something wrong. And this was the moment to prepare the company for the future, to tell them something is going wrong there, and what do you do about that? Because I guess now it's a little bit too late, and beyond the usual thing of reducing cash burn and things like that, then the business model, you cannot change a business model in 6 months, and therefore you need to have the right one at the beginning. The second thing is that now it's about future round, extending the runway. Again, it's much easier for the companies that managed their trajectory over a long time, thinking about the next fundraise. When you raise at 160 times, now the probability of a down round is pretty high. So at AVP, we didn't make any investment in the growth fund in 2021, not because we didn't want to, but we lost all the term sheet we put together, and one deal in the venture fund. And I would say when we lost this deal, we were telling the company, think about the long term, think about what will happen next, think about the next fundraise. What you want in the end is exit, is the IPO for the best one. And you need to manage the trajectory. What you don't want is this kind of ups and downs because it's unmanageable. So I don't know if I answered your question, but I would say now it's a bit too late, and it's kind of, and I'm sure you will, Guillaume, you will talk about that. It's more distress management of difficult situation. It's actually, it's a lesson to learn when you invest and when you build a company for 5, 7, 10 years. With a given fundraising, you prepare the next one, actually.
Sure. Guillaume, does that track with what you're seeing in your clients' portfolios?
Yeah, exactly. I think there are 3 trends that we see of things happening, and the questions was how the VCs are helping. Well, first, obviously, they do what they're good at, which is providing advice, sitting at the board. That's a reality check, let's say, be it extending the runway through focusing on some aspects of the business and some other, reducing costs. The second thing that we see is obviously, and we talked about that, lots of bridges, convertible loans. We see also, and we'll talk about that because I think the terms sometimes are pretty harsh, venture loans. And the third thing which is happening, and it's also in connection with what François said, is that's the reality check. Maybe it's the right time to realize that the story is not going to be that pretty, but it's the right moment for an exit. And maybe that means, not the best valuation. Maybe it's just 1x for the fund, but maybe that's the right thing to do. Maybe there is a competitor, maybe there is a large corporate, and that's the moment. And I think the VCs are helping also founders and management to realize that this is also an option that's on the table. And we see a lot of M&A, be it distressed or not.
Lots of M&A. Jean, is that any different at the early stage with your portfolio companies?
Yeah, lots of similar themes. So, one thing we hear a lot from pretty much all our managers is that focus on cash runway. Whether it's bucketed in the below 12 months where things might be getting a little bit hairy, 12 to 24 months, or ideally 24 months plus. And that is generally the combination of cutting burn, but also raising capital where it's available. I guess the real trick is knowing how deep to cut, because anyone can just reduce cash burn down dramatically, stop all growth. But we need these companies to be in the position where if things start to turn around in the broader economy, they can really take advantage of that and return to growth. And that's a hard balance to find. And what we find with most of our managers, they've invested or operated through the financial crisis, through the .com, and you're in a better place to offer that advice to founders because, again, you don't want to go too far. You still are investing in growth assets, and you need that growth to return as long as you survive.
Jean, any other color from the early stage?
Yeah, I think when you're sitting on the boards of those companies, what has completely changed is 2 things in my view. The first one is that something that became not negotiable is work on your unit economics, right? So there's no way that today you can run a company by saying, I have a negative gross margin today, but it's going to get better tomorrow when I get scale or whatever, which was something that people could sell actually in the past 2 years. So this is over. The second thing that is over is, I spend today because I will raise tomorrow. So now it's still possible to burn cash and to lose money and to grow very aggressively, but you have to get the resources before you start to, at least that's our advice, right? You have to get the resources secured for a good 2 to 3 years before you start spending and burning. So those are the 2 main changes. But otherwise, I think the market is still functioning. And the very important slide that you showcase is that 50-something billion of dry powder. It has to go somewhere, and the overall value created by the tech industry is tremendous. So it's not going to go anywhere. Waking up the room, I'll disagree with François on one thing. This is, to me, it is very different from the .com bubble, in a sense that in 2000, and I was around, the markets did put high price tags on awful companies. you know, and companies that were going nowhere with management that were clueless, and in many cases, not all of course, but many cases, businesses that will never exist. I would say that today, the vast majority of the companies, they're real companies, they're just mispriced. They were priced way too highly, but they're real companies. You know, they're doing good stuff. Even if they're at 100 times, you know, revenue, maybe they were doing 100 million in revenue, and 100 million of anything is a good number, right? So I'm not saying it's simple, because repricing downwards is a very difficult exercise, but at least we have the raw material, we have the management teams, and we have the companies.
That makes sense. I want to turn a little bit to more of a perspective look, deals that you're doing now, deals that you're excited about. It seems that the crypto winter is here. All anyone can talk about now is ChatGPT and what AI solutions are going to do across a number of industries. So are there any subsectors, industries, geographies that you think are completely over or undervalued right now in the venture landscape? Francois, I'll start with you.
Well, it's difficult to say. I mean, there was clearly some hype in some part of the market on the crypto side. Whatever you think about Web3 token and so on, there was clearly a hype in the sense that, you know, there were stories, but not a lot of numbers. So I think, without saying everything about the soundness of this technology, there's clearly a repricing which is probably sound. The risk is better priced now. You mentioned ChatGPT. I mean, it's very interesting to see that AI, there's a lot of, you know, different definition of AI, a lot of things behind AI, but real AI that can really, you know, profoundly transform industries is here. I mean, ChatGPT, you mentioned that, it's the visible part of the iceberg, many more to come, I would say. And this is probably, you know, this is not overpriced. Given, I mean, we are talking to some of our LPs that have a corporate side, let's say, to see where they allocated their budget. And several of them told us, look, 5 years ago, AI, we put a little bit of budget just to experiment things, right? Now it's real massive budget. So it's part of our IT investment. It's a big part of our IT investment. When you see that there will be a final demand. So, and by the way, just, I don't disagree with you, Jean. I agree. It's the factors are different, but the outcome is the same. There's massive value destruction, probably coming from different sources.
Sean, from the LP's perspective, are managers pitching you too often or not enough on certain sectors that you want more or less exposure to? Or are you more sector agnostic and you conduct your diligence based entirely on previous performance? Sort of walk us through that process.
Yeah, so for us as LPs, we often joke in-house that if we're really excited about a sector, we're probably 3 to 5 years too late. I think it's important to keep that in mind and stay humble. So we very deliberately select managers. We don't select geographies. We don't select sectors or subsectors. We don't make any sort of bets based on what we think is over or undervalued in any one of those sort of categories. To give you some nice examples, you know, you talked about crypto or Web3. Our exposure there started back in 2013 before we'd ever heard of it. And with ChatGPT, we managed to give our investors early exposure there because one of our funds backed OpenAI back in 2019, again, well ahead of the hype. And that's sort of what we like to think, because our VCs are the ones that are talking to entrepreneurs every day. They're seeing the flows of talent. They're seeing the new things bubbling up. And we want them to make the allocation decisions on where they're spending their time and investing their capital. So if you look at our portfolio, it is quite diversified across geography, across stage, and across sectors. But generally, that's via generalist VCs. So they're making those allocation decisions rather than us. And we're just focused purely on the manager side.
Jean, are there any specific technologies that you're excited about right now, or any maybe new business models as well?
Oh yeah, we're excited about a lot of things. We see a lot of things coming, obviously in health tech, you know, and everything digital that is coming to impact that massive industry. We see a lot of things coming with the cloud automation, and the great migration to the cloud is now pretty much advanced, and you need tools, you need everything. We're very excited about what you can do with the blockchain. So maybe you have kind of a winter, but that's the typical hype curve, and so now it's on for building. So many sectors will experience some downfall now, and will come back. Maybe fintech more than the rest. The swing. It was so highly priced, and now it's so depressed because. And sorry for my obsessions, but people dreamt about huge markets, but now people say, unit economics just don't work. So it's the total nightmare. But it will come back. Some entrepreneurs will find a way to make it work, and not all of them, but it will come back. It's inevitable.
I want to transition a little bit and talk about deal terms and valuations as well. We mentioned earlier that headline valuations are still sometimes going up a little bit, even if the company's not doing so well or the market has fallen out. And that's able to happen because deals are so highly structured with liquidation preferences and other terms. Guillaume, I'd love to get more of your perspective here. What effect will that have on these companies? What effect will it have eventually on LPs in these funds with more highly structured deals?
Yeah. Now, before we look at the FX, I think it's interesting also to discuss what does it mean, more structured deals, what we're seeing, because we're seeing a lot of transactions. So obviously we see liquidation preferences that have switched from the usual 1x non-participating. We see 1.5. We've seen in recent large growth equity rounds in France, 1.7, 1.8. We're seeing 2x's. So that's the first part. This comes with relative instruments. We see warrants, that are exercisable upon IPO, for instance, which effectively means that it's a down round. We're saying to the market, hey, we're raising capital at the same valuation, but if you're just doing the waterfall, it's dilutive. Obviously, the third item is the fact that ratchets are harsher, and that's exactly reflected on your curve from 0 founder friendly to 100 investor friendly. We clearly see that switch in terms of negotiation. So we used to have, broad-based ratchet. We see more and more full ratchet. We also see extension of the term of those ratchets, who used to be 3-4 years. Now we see 5-7 years. So we're looking at protections that are on the longer term. So clearly a shift in terms of what's negotiated day one in the term sheet on the table. And I think one of the key items that also relates to those cycles, discussing about what happened in the dot-com bubble, is that one of the key role that the investors can play with founders who have usually been on the market for 6, 7, 10 years, they have not seen a full cycle, with harsher terms. So it's one of the role is also to explain that this is things that were usual maybe 10 or more years ago and that are back on the table. There is some kind of maybe a generational gap with a full generation that has only seen a market like this and not a market that's flat. So and just to summarize, it's the issue will of course be exits where and I see that already where the liquidation preferences means that upon exit, the founders, the management, and all the ordinary shares get zero value, and that's already there. We see that quite often, actually.
We've seen in the past, and in the early 2000s, at least at Ventec, we have a very strong conviction: complexity kills companies. Loud and clear. So because you create, with the more complexity, the more you create conflicts of interest between shareholders. So after that, you end up with double dip preferred shares and ratchet and stuff like that, and options that are mispriced. And so everybody's disaligned, and you know, some people will have an interest to sell in a certain, you know, frame of valuation, and then it's a plateau, and then it goes down. It just gets crazy, and so it has a massive influence on how the company is run and how talent is recruited or not recruited or leaves. And so our advice to companies when it was mispriced a couple of years ago is, you know, guys, take the hit. You know, it's not nice. Everybody believed, you know, the company was worth 2 billion. Maybe it was not worth 2 billion. Take the hit, and that's it. But do not overcomplex. I'm sorry, but do not overcomplexify it, because ultimately it's going to kill you.
Yeah, one of the consequences of that is that we see a lot of repricing of the management packages, the strike prices also, because that's clearly a key issue in terms of recruiting the right talent when your strike price for your management package is way above the what's interesting. So yeah.
I want to turn now and talk a bit about fundraising. We had talked about how that had slowed in Q3 and Q4 of last year. It's likely to slow again this year, despite there being lots of dry powder in the market. Sean, from a fund of funds perspective, are your LPs sort of dealing with the denominator effect and slowing their commitments to your new funds? And are you seeing that when you're committing to new funds? Maybe other investors, when you're committing into primary venture funds, are they slowing their pace of deployment as well?
Yeah, so I mean, with our investors, our base is sort of quite diversified, so we're not seeing that as a huge impact. It has meant that the fundraising for our latest vehicle has taken slightly longer than expected, but again, given the backdrop of 2022, that's not a surprise. The nice thing for us is that because we're 100% allocated to venture, we don't have that issue when we're putting capital to work. One of our key philosophies is to stay really consistent through the vintage years. We don't try and time the market. We want to put money to work when it looks like things are frothy. We put money to work when it looks like the tech industry is never going to recover. We've done that for 35 years, and it's served us really well. You know, it's a sort of a bit of a cliche, but after a correction is generally the best time for returns in the venture industry. We saw that quite clearly after the financial crisis. But you never really know when you're out of that correction until you're halfway up the other side. So for us, staying really consistent, whether it's during the record liquidity we had in 2021 and everything was pretty irrationally exuberant, or now when things are slowing down dramatically in the deal making, when good high quality managers that are in our portfolio come back to the market, we want to be there to support them. And I guess the last bit, which is quite interesting for us in the current environment, is that as other people step back, whether it's because of they were tourist investors or they're suffering from the denominator effect when they're investing in venture funds, it allows us a little bit of time to play offense, whether that's accessing new groups where we didn't have access before, or whether that's increasing allocations in oversubscribed funds where we've been working maybe for decades to increase that allocation. So that makes it quite an interesting time and quite different to the last 5 years where we really feel that we've been playing defense.
Makes a lot of sense. We've got just a few minutes left, and I'll open it up for a brief Q&A, but last question for each of you. What's your outlook for 2023? What are your expectations for deal making? Will the exit market rebound? Francois, maybe we'll start with you.
Well, very difficult to say. I don't have a crystal ball, but maybe to continue what we said because it's related. First of all that is very connected to interest rate. I mean, the reason why we had this kind of exuberance was also because of the 0% interest rate environment. Interest rates are rising, so look at the interest rate to, you know, try to figure out what's going to happen on the valuation side. I would say for fundraising and the overall dynamics of the market overall, trust is very important. And just to continue what we said, Jean said, take the hit. I think it's super important. It's super important for companies to realize that, yes, things have changed, multiple have changed. It's important for VCs to realize that, and it's very important also to keep the same level of trust with the LPs. There is the denominator effect, there is a liquidity constraint and so on. That's true. But even more than that, many LPs, especially in Europe, are thinking, what's this VC market? So of course, there's this huge technology trend, technology innovation. It's a super, super strong tailwind. It will continue for a long time. But trust is essential. What we see, we have a pretty sizable for the fund business, is that in the US, like very often, things have adjusted very quickly. You know, funds have marked down their position. Company have realized that yes, things have changed. I don't know what you see in the US market, but we see less structured deal because there is, valuation have adjusted. Much less in Europe. Also because there's a lot of public money in Europe that helps the fund to, still 5 minutes, please. I think it's super important. I was saying in our fund business, we see for the same company with multiple LPs, different of valuation as big as 40%. LPs know that. I don't know what you see, Sean, but that's really bad. That's super bad. So transparency. It's not a prediction, it's a wish for 2023.
Guillaume, expectations for this year?
I'm not really good at outlooks. That's why, as a student, when I had to choose between being a VC and a lawyer, I decided to be a lawyer because I'm not good at predicting the future. It's just a joke for my friends, but I can say what we're seeing currently, which I think is what's going to make 2023 is consolidation in the shared mobility, delivery, sectors, which means that maybe valuations have landed there. We see active fundraising in biotech, in quantum physics. There have been a large rounds that has been announced yesterday in France. It's actually one of the largest round in that sector for a French company called Pascal, 100 million. That's a lot in that sector. So there is still sector, of course, AI. And I think we will continue to see, because we're working on a few of those deals right now, M&A, some of them distressed M&A. As François said, sometimes it's the right time to do a dual track where you know that fundraising is likely not going to be the right option, and exit is the right time. We see interesting business, let's say, combination, like the one that's currently closing between BPC, the French bank, and Swile company. Lots of those exits. So those are companies that in the last 2 or 3 years could have raised money and continue a different story. But I think my outlook is fundraising in specific hot sectors, and of course continuing flow of funds, because there's a lot of dry powder in seed and Series A, and more M&A for sure.
Sean, how about you?
Yeah, I think not to put too much of a downer on things, but I think things are probably going to get quite a bit worse before they get better. What we haven't seen so far is lots of companies, going bankrupt, and high-profile companies. We haven't seen a lot of, in our portfolio, the real sort of cram down rounds where companies are getting recapped because they got way out ahead in terms of valuation relative to where their business model is. And we haven't seen, I guess, VC managers struggle to raise and leave the market. And I think people that started out in the very frothy environment of the last couple of years, it's going to be very, very tough for them. So I think that is still coming, but I think that's a good thing for the industry. We've seen it in the past. Over the last sort of 35 years, that's generally a good thing. And I think the industry at all levels, from LP through down to the entrepreneurs, will emerge stronger from that. I think long term, we're still extremely bullish. I think the value that tech is bringing to society and the value it can capture is incredibly high, and it's only increasing. It's definitely not going away. Over the long term horizon, it is going to increase, but there will be some short term pain. And I think just sort of lastly on that valuation question, we do see a spread of valuations between different companies holding the same company. But generally, we consider any sort of intermediate valuation as a bit of a made-up number until it's realized in cash.
Sean, final comment?
Yeah. So of course, no crystal ball either. But my view is that 23 will be the year of triage, as you mentioned in one of your slides, and cleaning up the portfolios. So it's not going to be super nice, but expect companies to fall. So any experienced manager. Well, the thing is that half of the managers that were not there at the last bear market, right? But so they're going to learn it the hard way. But expect experienced manager to kill companies, and it already started, at least in our portfolio. in H2 22 was the first time in many years where companies were saying, if you don't help us, we're going to shut down. And say, yep, you're going to shut down. That's how it is. And I remember a year ago, I told my LPs on one of our funds that was 5 years old to say, you know, IRRs are going through the roof, but there's one number that is absolutely not sustainable, is that we have 4% of loss in that 5 years old portfolio. This is not the model. It is not. There's no way it will continue like that. We'll reach historical numbers because that's what it is. That's how you do venture capital, and you have to take risks. So now it's happening, and it's okay.
Wonderful. I'm afraid we're out of time, so we'll have to skip the Q&A for now. But please join me in thanking our panelists. Thank you.